Welcome to the latest episode of Millennial Money.
So this week we're actually going to talk about interest rates. So in the world of money and finance, interest rates is a term that is thrown around quite a lot, and there's different types of interest rates as well. But what do they actually mean? What are they? And what's the difference between them?
Right, this kind of got born out of the last video we did when we talked about cars and finance and best ways to buy cars, and I mentioned something called APR. I didn't elaborate on it there, and somebody wanted to know what that meant. Now, when you go and take out a loan, for example, you may see something called the annual percentage rate, or APR. And equally, you may see something else in the finance world called the AER, which is the annual equivalent rate. Now, they're two very different things, but they're both important. The problem you have if you focus on APR is that is used when you apply for things like loans, credit cards, mortgages. The problem you have is when you go and look at different credit cards and loans, how do you compare apples with apples? Because there can be different charges, different interest rates. But if you have two loans and they have the same interest rate but they have different other charges applied, then it can be very difficult to work out what is the overall amount you're paying, because it depends on how long you pay it for, and as I say, the different charges. Now what they've done is they've got the annual percentage rate, which is a rate that takes into account not only the interest rate but all those charges that you would pay if you were taking out the particular loan. And it's an annual rate, which means that if you take the APR on one product and compare it to the APR on another product, it can give you more of a comparing apples with apples to see which is more expensive. Now that is great, but there are of course drawbacks, because if you are looking at the APR, that isn't the actual rate you pay. It's an annual percentage rate that bundles all the charges together. So it won't be, so let's say for example you had a teaser rate that was cheaper on a loan at the beginning and then it went higher later on. That APR rate that you'll see quoted will be very different to the lower rate you're paying at the beginning. You've got to think of it more like an average over time. Now you'll also hear the equivalent APR bandied around, and that really means that the rate that is typical for 51% of the people out there, because the equivalent APR, the APR you see quoted when you see all these wonderful adverts out there, is not necessarily the one you'll get, because it will depend on what sort of risk level you are. It depends on your credit report. So if you're higher risk, you'll pay a higher rate. The representative APR has to be a rate that 51% of customers, so the majority, would actually receive, so it makes it relevant.
Okay, so that's APR explained, but what about AER?
Now, AER applies to savings rates. So what it does is it does a similar comparison, so we can compare apples with apples. So if you have two savings accounts, and it will take the rate that you receive, so the interest rate and any bonuses and all that kind of thing, and it will put it into an annual interest rate, so you can compare one account to another account on an annual rate, so it's an equivalent comparison, so you can see which is the more generous, and that's called the annual equivalent rate. Now again, there are drawbacks. If you think about the AER, if it takes into account again some sort of teaser bonus rates at the beginning that may be higher and then drop to lower, what it will do is it will take again an averaging of that. So the AER won't be exactly the interest rate you get paid on a given day or time or anything like that. So the other thing you've got to bear in mind is that AER is slightly different to the gross rate you see quoted. Now the AER can be slightly less than the gross rate that you see quoted out there, especially if it's paid on a monthly basis. So on a monthly basis it can be slightly less. If it's an annual basis the interest is paid, then the two things will be broadly the same. But don't get too bogged down about it. All you need to remember for this video is that it's for comparison purposes. So APR, if you're taking out loans, credit cards or mortgages, so basically debt, and then you look at the AER if you're looking for savings.
Okay, so that's it for this week's Millennial Money. Thanks so much for watching. If you have any questions, email me, lauren@moneytothemasses.com. As usual, head over to our social media channels, our Facebook, Money to the Masses, our Instagram @MoneyToTheMasses, and our Twitter @MoneyToTheMasses with the number 2. Also, subscribe to our YouTube channel. Thanks so much for watching, and see you all next week.